Welcome to another fundamental breakdown. Today we are talking about stagflation. Now you might have heard about this term before. It was kind of, a lot of people are talking about this in 2022, slightly into 2023 as well. So let's get straight into this video. So what is stagflation? Stagflation is when there's a period of low or weak growth but high inflation. You will need to look at data such as GDP or the unemployment rate to gauge if the economy is experiencing stagflation. As inflation rises, this naturally puts pressure on consumers and reduces their purchasing power. Because remember, if inflation rises, things become just a little bit more expensive. And naturally, that means you're spending out a little bit more. And naturally, it means, you're technically earning slightly less. So this generally weakens the economy over time. So if the economy is stagnating, this won't be a good sign. And stagnating is just another word for saying stagflation. Again, if the economy is weak already, right, but inflation's high, inflation generally weakens, the purchasing power. It means you can buy less with your money, basically. So that means it's going to put a little bit more pressure on growth. So what are the causes of stagflation? Stagflation can happen in several ways, and it's your job as a trader to understand what is causing the weak growth and high inflation environment in the economy. So causes. So number one is supply shocks. This is when there's a sudden disruption in supply of goods, which will drive up prices and reduce output. For example, a supply shock could be an oil refinery being disrupted, which drives oil prices higher, and as a result, puts more pressure on consumers due to higher prices. So as we know, whenever there's for example, a good example of that is like a war. When a war happens in let's say the Middle East, obviously they produce a lot of oil. That may put some pressure on oil prices to push higher. And naturally, if the prices of oil are pushing higher, companies will have to, potentially pass that on to the consumer. And as a result, you're paying more for oil, basically. Cost push inflation. So as you've learned through the inflation videos that Drew has made, cost push inflation. So if companies are seeing a rise in their costs, like wages or prices for materials, they may not want to eat that into their margins. So think margin like a pot. A pot is like their margin. And if they're saying actually, the price of our material is pushing slightly up, they may not want to eat that into their pot, right? And they will likely pass it on to the consumer via, higher prices. And that's cost push inflation. Demand pull inflation. So if demand for the goods is very high, the companies may raise their prices, which will create an inflationary pressure, even if the economy is weak already. So this is something of, think of yourself as a company. You want to be obviously making as much money as you can. So naturally, whenever you see a demand increase, you tend to see companies raise their prices, and that's demand pull inflation. Demand's really high, that then pulls inflation up. And of course, policy mistakes. So a policy mistake is if the government or central bank makes a mistake with their policies, and this can drive up the prices of goods and services. So it's just a historical instance of stagflation is the perfect example. One that's referenced a lot is in the 1970s. So the most common one is referred to the 1970s stagflation era. This occurred mainly in the US, but also affected other Western economies. The stagflation in this period was caused by a few things. Number one was an oil price shock. So during this time, OPEC Plus in 1973 implemented an oil embargo. This restricted the amount of oil going to Western countries supporting Israel during the Yom Kippur War. This drove oil prices up massively by almost fourfold, so almost 4 times the amount in that period or during that decade. So OPEC, they restricted the amount of supply, remember, so to understand commodities, it's just to follow supply. So if the supply of oil is being restricted to a certain economy, that will naturally push prices up. Number two was cost push inflation. So as the price of oil rose, this caused a bleed through effect on production and transportation. Because naturally, when a ship is, moving from one end of the continent to another, or one end of the world to the other, or you're flying a plane from the US to Europe, for example, delivering goods, you have to use oil for that. And if the prices of that has risen, then the company will likely pass that on to the consumer, which is that cost push inflation. And previous policy. So this is a monetary policy perspective. But in the late 60s and early 70s, monetary policy was very accommodating, so very dovish, as the Fed was lowering interest rates as well as adding more money supply. In this environment, they aimed to stimulate spending and help push inflation back towards their target. So, late 60s, early 70s, inflation was trending lower. They were cutting and cutting and cutting. And as you know, when you're cutting interest rates, things become, borrowing becomes a lot cheaper. Mortgages become slightly cheaper. Just general things become, more consumable. So naturally, if that is occurring, people are buying and buying and buying and buying and buying. If you couple that with the oil shock that we saw here, then that generally is not going to put, and it's a toxic flow, basically. And a wage price spiral. So a wage price spiral occurred as when the prices rose, workers demanded higher wages. So a good example of that is look what we saw during 2022, 2023, and also into 2024, where wage growth was rising and rising and rising and rising with inflation. So what has happened is because demanders or the workers saw a massive rise in prices, naturally you're going to ask for higher wages because you want to battle that higher prices. And as companies gave wage increases, they would then increase the price of their goods to offset the rise in wages, because naturally, if you're going to give people more money, that means there's less money going to the company itself. So they're going to have to do something to make more money, right? So they're going to raise their prices. And that created that toxic flow, also known as a wage price spiral, where wages rose, companies had to raise their prices to battle that. And then naturally, the workers be like, actually, we want more money because the prices are now rising. They got a higher wage or higher wages, then the companies rose. And you can see it's like a step-by-step process, and that's known as a spiral. So stagflation in the 1970s. And as you can see here, start off with inflation. And you can see this is the 1970s era. We came in to early 70s, as we were mentioning earlier. Inflation was lowering. They were cutting. And then we saw it massively rise because of all of the things that were happening in that war. We then sold off slightly, and then we ended sort of the decade at 11% or just below 11%. This is unemployment rate. So if unemployment rate is rising, then tailed off slightly towards the middle of the 70 era, then rose massively. And as you can see, that's just not a good sign for any economy, really. And that was just a stagflationary environment, unemployment rate rising massively during that decade, and wage growth as well. As you can see, wage growth started to tail off alongside with inflation. And then naturally, when that war is happening, we then saw that massively rise because people were demanding higher wages alongside higher inflation. And then naturally, that just created that wage price spiral. So how do you deal with stagflation? To deal with stagflation, the central bank and government will need to implement tools to keep inflation under control without causing an issue for growth. They could raise interest rates to bring inflation under control, but this will cause growth to slow further. The central bank or the government will see this as a short-term trade-off. So they'll be like, okay, yes, we know when we raise interest rates, that's generally going to slow growth anyway, but they're going to see it as a short-term thing. They'd rather get inflation under control. As long as they target inflation, this anchors inflation expectations lower, which will help firms price wages and price goods better. What we mean by that is if they're trying to keep inflation under check by talking about it constantly, saying we're going to do this about inflation, we're going to battle it here and here and here, companies now have a better idea of where inflation might be in the future. And therefore, when workers demand higher wages, they'll be like, well, the central bank has said they're going to do this, and this. This should help inflation lower. So we're not going to give that wage increase at this moment, for example. That's what a company will then do, and that will help bring inflation lower as well. The government can implement fiscal constraints to help curb inflation. They can reduce their budget deficits by cutting government spending and raise taxes. Remember, the aim is to mainly bring inflation under control. So yes, growth may be hurt further, but this is seen as a short-term trade-off. Generally, if the economy is facing stagflation, the currency weakens. So again, remember, as a trader, you might be thinking, yes, rates might be rising. Yes, that's generally pretty good from an investor perspective. But the investor may not want to invest into that, government bond, for example, which then increases the currency because of the fact that if the economy is weak already and the government's doing all of this, the higher likelihood of a default is increased, and therefore it's seen as less attractive. And generally that's when the currency weakens. So you'll learn about that all later in later videos, of course. So that is stagflation, and it's simply when growth is really weak and inflation is really high, you have to think about what's the reason stagflation is occurring. Just because, let's say, GDP is really low and inflation is high, that's not technically stagflation. What you want to be focusing more on is the overall data. Because remember, GDP could be really weak from what you've learned in the previous videos about the components of GDP. Maybe imports and the export market is really bad. Well, that generally isn't like a concept of a really weak economy. You also would be looking at the unemployment rate. What are the causes of this weak growth is really important here. So that's it for stagflation. We'll see you in the next video.